Welcome to the deep dive. This is the show really designed for you. We try to cut through the noise, give you those aha moments, get to the important insights, maybe some surprising facts, and really actionable stuff. Today, we're diving deep into the Q1 FY26 financial results for the Federal Bank Ltd. These just came out right, approved August 2nd, 2025, for the quarter ending June 30th.
That's right. And our mission today is really about going beyond just the headline numbers. We want to unpack what really matters in these results, connect the dots, so to speak, link it back to their big strategy, Federal 4.0, and of course, what's happening in the economy. We've looked at the official investor presentation, the press releases, and yeah, the earnings call transcript too, to give you the full picture.
Okay. Let's unpack it then. So, the big picture first. Federal Bank, they've really climbed the ranks now, the sixth largest private sector bank by total business. That's huge, reaching 5.29 lakh crore. And just for perspective, especially for our international listeners, 1 lakh crore is 100 billion rupees. So 5.29 lakh crore, that's what, roughly 64 billion US dollars. And that's showing 9% year-on-year growth. Pretty solid. So how are they pulling this off? It seems to tie back to this big strategic plan they have, Federal 4.0. They introduced it back in February, and it sounds like more than just a buzzword. It's meant to be a real transformation plan, yeah, an actual roadmap.
Exactly. And if you really boil down Federal 4.0, sort of simplify it like management did, it comes down to, well, three core goals. Things aimed at fundamentally changing the bank's DNA, you could say. First, improving their CASO, that's current account savings account, especially the current account part. Basically, CASA deposits are like the cheapest money a bank can get. So if they increase that, they pay less interest out. It directly helps profitability. They call it addressing the cost of funds.
Yeah.
Second big objective, get better yield on advances. So earn more from their loans. They plan to do this mainly by reshaping the asset mix, changing the types of loans they make, and also increasing granularity, which just means spreading loans across more customers, not just a few big ones. And third, just increase the volume of fee income. So they're not quite so reliant on just interest.
Right, diversification of income streams makes sense. And what's really striking, you mentioned this, is even with, the tough economic climate everyone's facing, these Q1 numbers, they already seem to show them actually doing these things, executing in line with those three objectives, making real progress.
Yeah, tangible progress is visible despite those systemic headwinds.
Okay, so we've got the strategy. Now let's ground ourselves in the actual numbers. The proof is in the pudding, right? Core financial performance for Q1 FY26. Operating profit, 1,556.29 crore. That's up 4% year on year. And total other income, that hit a record high, 1,113 crore, up 21.61% year on year. That's quite a jump. And the bottom line, net profit came in at 861.75 crore.
Right, and that net profit figure needs a bit of context. Because while operating profit grew, the net profit actually fell, down 15% year on year and 16% compared to the last quarter. Now, management was very clear about this on the earnings call. They said it was mainly because of higher credit costs, specifically provisions they had to make for their agri and MFI portfolios. So it's not necessarily a broad weakness, more like a targeted hit from dealing with issues in those specific loan books.
Okay, so specific provisioning, not a general slowdown in profitability. Got it. Digging a bit deeper then. Net interest income, NII, their core lending profit. That was 2,336.83 crore, up 2% year on year. So slight growth there.
Yeah.
And earnings per share annualized 14.07.
And the net interest margin, NIM, landed at 2.94% for the quarter. NIM is, well, it's a really key profitability metric for banks. How much they make on loans versus pay on deposits. Higher is generally better. What's really interesting here is how the RBI's repo rate cuts played into this. Remember, there was a total of 100 basis points cut since February. That's a full 1%, including 50 basis points just in June. And Federal Bank has this T+1 repricing policy.
T+1 meaning?
Meaning rate changes like those RBI cuts hit their loan and deposit rates almost instantly, like within a day or so.
Yeah.
So that a quick adjustment is why a lot of that rate cut impact is already baked into this 2.94% IM. Management actually said they think NIM will probably bottom out in Q2, assuming, of course, no more rate cuts. And they only expect maybe a small dip next quarter, like 5 to 10 basis points.
Okay, that's helpful context on the NAM dynamics. What about overall efficiency? Return on assets, ROA, came in at 1.00%. And return on equity, ROE, at 10.3%. That ROA figure, 1.00%, how does that compare? And did management give any color on that?
Yeah, good question. They did address it. They said the ROA would actually have been closer to the last quarter's 1.24% if it weren't for those specific MFI provisions we talked about. So, yes, it diffed, but it was an expected hit from sorting out those specific portfolio issues, not something broader.
Right, understood. So profitability picture clear. Now, the always critical question for any bank, asset quality. How's the loan book looking? Gross non-performing assets, GNPA, 1.91%. That's actually better year on year, down 20 basis points. Net non-performing assets, NNPA, 0.48%. Also better, down 12 basis points year on year. And their provision coverage ratio, PCR, pretty healthy at 74.41%, up significantly, 362 basis points year on year. On the surface, those numbers look quite strong.
They do paint a good overall picture, definitely. But the earnings call did dive into some specific stress points, mainly in MFI, microfinance, and the agri portfolios. Management pointed out this stress was quite concentrated, mostly in Karnataka, which makes up about 20% of their MFI book. The positive sign, though, is that slippages, new loans going bad, apparently peaked back in May, and they've seen a secular fall, their words, in June and July. Management actually said, and this is a direct quote, "The worst is behind us for those MFI slippages," although they did caution that provisioning setting money aside for losses might lag. Could see that effect for another quarter.
Okay, worst is behind us is confident language, but they still expect a provisioning lag. You mentioned it was concentrated in Karnataka. How much of this confidence is based on, like, real recovery signs versus maybe just optimism? Are there concrete things besides just fewer new bad loans that back that up?
That's fair. They are being confident. The main concrete thing they pointed to was that consistent drop in fresh slippages in June and July after May's peak. They also mentioned internally seeing collections improve significantly in those specific regions. So there's some operational data behind it. And importantly, outside of MFI and agri, they stressed that slippages everywhere else, think retail, corporate loans, were broadly stable. Some even got better. There was maybe only a marginal deterioration, they said, in business banking and CVCE, that's commercial vehicle construction equipment. Plus, the bank is taking an accelerated approach to provisions on unsecured loans. Aiming for 100% provision relatively quickly shows they're proactive. Overall credit cost for Q1 was 65 basis points annualized. The guidance for the full year is around 55.
Okay, so for you listening, the takeaway seems to be, yes, there was concentrated stress, MFI and agri, mainly Karnataka. But the bank seems to be actively managing it, sees recovery signs, and the rest of the loan book looks quite resilient. Does this feel like genuinely disciplined risk management, or are there still maybe some underlying things we should keep an eye on?
I'd lean towards discipline. The fact that it's contained, they're open about it, and using accelerated provisions. That suggests a cautious approach. The main thing to watch, I suppose, would be if those MFI data recovery trends stall or if some new weakness pops up elsewhere. But for now, their focus seems right.
Excellent perspective. Okay, let's shift gears to the growth engines. Deposits and advances. Total deposits. UHO, 2,087,436.31 crore. That's up 8.03% year on year. Net advances, their loans basically, 2,041,204.34 crore, up 9.24% year on year. Solid growth on both sides.
And on the deposit side, the real story is CASA. Remember that cheap funding source that grew over 12% year on year, reaching 87,236 crore. That pushed their CASA ratio up to 30.35%, which is a nice improvement, over 100 basis points year on year, and even up slightly quarter on quarter. That directly helps their cost of funds goal under Federal 4.0. They also saw good traction in retail term deposits this quarter, so it seems broad-based.
And on the lending side, the advances growth seems very targeted, very strategic. Look at these numbers. Commercial banking up over 30% year on year. CVCE, commercial vehicle construction equipment, also up over 30% year on year. Credit cards, strong growth too, nearly 19% up. And gold loans, up almost 14%. Management specifically called out strong growth there in June after some regulatory things got cleared up. This isn't just random growth, though, is it? It feels very deliberate.
Absolutely not random. It ties directly into that Federal 4.0 plan, the one about rebalancing the asset book and improving yield. For example, they mentioned their fixed book. A segment of their loans has deliberately grown from 26% of the total to 33%. What that really signals is a calculated shift. They're not just chasing any loan growth. They're actively changing the mix of loans, moving towards potentially higher yielding assets, maybe with a different risk profile. It's a conscious pivot. And things like their Free the Branch initiative, restructuring their retail asset teams, those are designed specifically to fuel growth in these targeted areas. It's a whole system push.
Makes sense. It's growth with purpose. Okay, let's talk tech. The digital side of Federal 4.0, how are they using technology and improving efficiency to hit these strategic goals?
Well, quite a few things highlighted this quarter. Their main mobile app, Fed Mobile, got over 15 new features, always improving customer experience there. Then there's FedOwn. That's their unified digital platform for businesses. It's now live with new collection payment tools, making things smoother for corporates. They're even testing out generative AI. Got a chatbot in alpha testing internally, like a co-pilot for employees. And the plan is to embed AI deeper into customer and employee processes down the line. You can see the impact in the numbers, too. Digital transactions were over 92.5% of the total in June. That's huge. And the mobile banking transactions themselves are way up year on year, hit 133 lakhs.
And it's interesting how they frame the digitization, right? It's not just tech for tech's sake. They talk about the human at the core. It seems strategic, not just PR, like that Savings Ki Vidya campaign with Vidya Balan. That's not just branding. It's clearly aimed at boosting CASA deposits, hitting that cost of funds goal, or pioneering biometric authentication for e-commerce. That's about making digital banking easier, smoother for customers, which drives adoption. And they even ran a cybersecurity campaign, Twice as Wise, to help customers stay safe.
Exactly. And on the pure operational efficiency side, there's Project Udine. That's about taking routine tasks out of the branches, so staff can actually focus on talking to customers, building relationships, selling. They've set up 70 regional business service centers and loan service centers to handle that back office stuff centrally. They've also completely redone the performance scorecards for branches and staff. Big change. Liability products like CASA now have a much higher weightage, over 50% for branches, again, really pushing that strategic goal. And they've rolled out a leaner, maybe lower cost sales force model. Management seems confident that even with these tech investments, they can keep the cost-to-income ratio in the mid-50s range because they're finding efficiencies elsewhere.
It's okay, lots happening on the digital and efficiency front. Let's round this out with capital strength, subsidiaries, and ESG. How stable is the bank financially? Capital adequacy ratio, CRR, a very strong 16.03% under Basel III rules. That means they have a really healthy cushion against potential losses. And net worth keeps growing, up over 12% year on year to nearly 34,000 crore.
And briefly on their related companies, Fedbank Financial Services, their NBFC arm, where they own about 61%. Its assets under management grew 19% year on year, reached almost 15,700 crore. And importantly, 96% of that is secured lending, which is generally lower risk. Then there's Federal Operations and Services, a fully owned subsidiary doing ops and tech work for the bank. And they have a 26% stake in Aegis Federal Life Insurance, giving them a presence in insurance too.
And beyond the financials, there's a clear focus on ESG, environmental, social governance. Seems important to them. They highlighted women making up 43% of the workforce, 10% of the board. That's notable on the social side. Environmentally, they're building a Grow Green portfolio, hit almost 9,700 crore in June, up over 4% just from the previous quarter. Shows a real commitment to financing sustainable projects. Plus, they have their own in-house solar power generation.
Right, and they're getting recognized for it too. Named ESG Champion of India 2025 by Dun & Bradstreet. Plus awards for cybersecurity, so external validation as well.
Okay, let's try and wrap this all up. To summarize our deep dive today, the federal bank looks like it's really in the midst of executing this bold federal 4.0 strategy. You see them actively rebalancing the loan book, pushing digital hard, all aimed at future growth. And they manage this even in what they called a seasonally soft quarter. And while dealing with those specific MFI and agri challenges, it really does feel like a bank in motion.
I agree, and management sounds quite confident looking ahead. They expect growth to pick up more in the second half of the year, driven by these strategic initiatives really starting to bite and this constant focus on sustainable growth, risk discipline, and improving productivity. That seems to be their mantra, building for the long haul.
So what does this all mean for you listening in? Well, this deep dive into Federal Bank's Q1 results shows a bank that's not just reacting, but actively adapting. Adapting to the big economic trends, yes, but also to its own internal strategic priorities set out in Federal 4.0. It's a really interesting case study of a financial institution navigating a pretty complex world right now, proactively shaping its own path. Which leaves us with a thought, maybe something for you to ponder. As we watch banks and other companies navigate these, choppy economic waters and rapid technological shifts, how critical is finding that right balance, the balance between ambitious growth targets, really tight risk management, and that relentless push for digital innovation? How important is that mix for building long-term resilience and creating real value? It's something to think about, perhaps, as you look at how these deep dives into specific company strategies might inform your own view of the broader market. Thank you for joining us on this deep dive.